Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity. Hello, my name is Tom Vassallo with MRW Financial Brokerage, and thank you for participating in this episode of Long-Term Care Seed. In this episode of Long-Term Care Seed, we're going to discuss how your clients can access their non-qualified annuities income tax-free. Many times we have clients that may have been inherited, or you may have inherited a non-qualified annuity and they don't really need the funds for retirement. The perfect prospect for this is a client that currently owns a non-qualified annuity that has gains in it. We quickly change the conversation that those gains also equal a deferred tax liability, and that deferred tax liability passes on to the next generation. There is no step up in basis when it comes to non-qualified annuities. They do not need this annuity to fund their retirement lifestyle, and it's the type of client that's upset about required minimum distributions because all it's doing is increasing taxes. Many of these clients that meet this, these points, they view that non-qualified annuity sort of as a dormant asset that's become more of a legacy tool. Yes, maybe if they need long-term care or for some other type of emergency, they may tap into that non-qualified annuity, but they don't need it to fund their normal retirement expenses. If you watched our long-term care seed a couple of weeks ago, we reviewed our initial long-term care planning guide. This is the initial fact find and lead generation tool. And part of that initial long-term care planning guide is a page that shows if you needed care today, how would you fund long-term care? Which bucket of money would you go to? Cash equivalent, retirement accounts. And if your clients have annuities, you want them to click on this link or scan this QR code to watch this brief video. Let's take a look at it right now.
It is important to understand the tax and estate consequences associated with using an annuity to fund long-term care expenses. Annuities can be a valuable tool in securing your financial future. But what happens when long-term care expenses arise? Using annuities to cover long-term care costs might be an option, but it's vital to comprehend the potential implications. First and foremost, tapping into an annuity to fund long-term care could significantly impact your healthy spouse's ability to maintain their lifestyle. Taking or increasing withdrawals from an annuity could subject you to ordinary income tax. This means a portion of your withdrawn amount might be taxed as part of your regular income, and potentially increasing your marginal tax rate. Additionally, these withdrawals could be subject to the 3.8% excise tax, which supports funding for Medicare and other health programs. Moreover, higher income as a result of the annuity withdrawals might lead to an increase in your Medicare premium surcharge, potentially leading to higher healthcare costs. Increasing annuity withdrawals may also elevate your provisional income, leading to more of your Social Security benefits becoming taxable. However, there's an alternative worth considering: annuities compliant with the Pension Protection Act. Through a tax-free exchange to one of these PPA-compliant annuities, you can access your fund's income tax-free for long-term care expenses. This allows you to sidestep all the aforementioned tax and estate consequences. To wrap up, while annuities can provide financial security, it's crucial to be aware of their potential tax and estate implications. Utilizing a PPA-compliant annuity through a tax-free exchange offers you a tax-efficient solution to cover long-term care costs.
So let's now use an example where a client has an existing non-qualified annuity. This is our one-pager. That all of this can be branded with your contact information. And let's start off at their current traditional annuity. Maybe when they put $100,000 in, it has $100,000 of tax-deferred growth, so it's worth $200,000 at this point. Because non-qualified annuities are taxed last in, first out, the first $100,000 that they take out is considered taxable income. At a 24% tax bracket, they're going to pay $24,000 in taxes. Of course, the cost basis, the original investment, is returned income tax-free, so they'll receive $176,000 out of it, or if you look at it in terms of the tax liability, they have a $24,000 deferred tax liability. Now, even if they're using this to pay for actual long-term care expenses, this $100,000 that comes out will be taxable income to them. But the federal government, through the Pension Protection Act, wanted to encourage people to pre-plan for long-term care. So it doesn't matter how this existing annuity is titled. If it's in the husband's name or wife's name, they must be married, and that just has to do with the current tax laws regarding spousal continuation of annuities. So they must be married. But if the husband's the owner and annuitant, we can still 1035 exchange this to an annuity compliant with the Pension Protection Act and cover both of them for long-term care. So the way it works, we still have an account value. All $200,000 came over. Currently, this annuity is crediting a 5% fixed interest rate. That interest rate varies each year. If they take the money out for funds other than long-term care, the same tax consequences will occur. And there are 10% free withdrawals in this particular annuity that I'm thinking of. The first $100,000 they take out is considered taxable growth and will be added to their ordinary income. But here's where the Pension Protection Act really creates a lot of leverage. If they take it out for a qualified long-term care expense, and it has to be an annuity compliant with the Pension Protection Act, then we're taking out their original investment first. The best way to think about this is the tax break is there for your client, not for their children. So they're withdrawing their original $100,000 first, income tax free. If they take it out for anything other than long-term care, the tax deferred growth comes out first, and that's taxable. But for long-term care, it comes out income tax free. Once they've exhausted their original cost basis, then it moves on to the tax deferred growth. And if it's coming out for long-term care, that comes out income tax free as well. And once they exhaust their account value in their annuity, in this case, there's an additional $400,000 that will continue to come out income tax free. So we're receiving a total of $600,000 for long-term care expenses, income tax-free. The best way to think of this is while both husband and wife can be covered for this, they have one pool of money that they're drawing against worth $600,000. Now, as this annuity grows, currently it's crediting 5% interest, so will the additional value. So if it grows from $200,000 in account value to $300,000, we would still get the $100,000 of original cost basis out income tax free. Now there'd be $200,000 of growth that would also come out income tax free, and there'd be an additional $600,000 of additional long-term care coverage that would come out, increasing that total long-term care coverage to $900,000. As with all of our material, we've integrated videos that your clients can click on if you email it to them, or if they scan the QR code, they can watch the video. Let's take a look at this brief video.
Hello, I'm here to talk to those of you who, like this lovely couple, have wisely invested in a non-qualified annuity years ago. You've secured a comfortable retirement lifestyle and may not need this annuity to support it, but there's more to consider about the future of your annuity and its impact on your legacy. Many of you might not be aware, but when you pass on a non-qualified annuity to your children, it comes with a deferred tax liability due to LIFO, or last in, first out taxation. Let me explain this. With LIFO taxation, the gains from your annuity are taxed first when distributions are made. If you're not planning to withdraw these funds for retirement, you're essentially passing on a deferred tax burden to your children. However, there's a strategic way to manage this. Consider this. There's a 70% chance an individual age 65 will need long-term care, and for couples, it jumps to a staggering 91% that one or both of you will require long-term care. With such high probabilities, it's prudent to prepare. A Pension Protection Act annuity can make a significant difference. By transferring your existing annuity income tax-free to one compliant with the Pension Protection Act of 2006, the taxation changes dramatically in your favor. Unlike LIFO, where gains are taxed first, a Pension Protection Act annuity uses FIFO, or first in, first out taxation for long-term care expenses. This means your original investment, also known as the cost basis, is used first. However, the tax benefits of the Pension Protection Act annuity do not stop there. Once your tax-free cost basis is exhausted, the otherwise taxable gains can be withdrawn for long-term care expenses, income tax-free. Moreover, these annuities can extend long-term care benefits up to 3 times more than your annuity account value. And of course, those benefits are also income tax-free for long-term care. And if you're concerned about your or your spouse's health conditions, like Alzheimer's or Parkinson's, or even if you currently require long-term care services, know that there is a Pension Protection Act compliant annuity that is guaranteed issue. So regardless of your health conditions or your current need for long-term care services, you and your children can benefit from the tax-free access to your funds for long-term care expenses by transferring your existing non-qualified annuity into one that is compliant with the Pension Protection Act. As we approach the end of our discussion, there's an important aspect we must not overlook: the smart handling of your capitally appreciated assets, such as your brokerage account or real estate, for long-term care expenses. Let's consider this. If your current plan is to liquidate any of your capitally appreciated assets to fund your long-term care expenses, you will face capital gains taxes. This tax burden can significantly reduce the net amount available for your care, forcing you to liquidate more of your assets to funds to generate enough net cash flow to fund your care. Remember, the cost of long-term care is an ongoing monthly cash flow expense, not an asset problem. But there's a brighter side. If you preserve these capitally appreciated assets and pass them to your children, they will receive a free step-up in basis. This step-up can effectively avoid capital gains tax, maximizing the value of your legacy. Why should you or your children pay taxes unnecessarily? Contrastingly, if you pass on your non-qualified annuity to your children, it does not receive this beneficial step-up in basis. Instead, you're transferring a deferred tax liability along with the annuity. Your children will have to pay ordinary income taxes on the LIFO taxation structure of your annuity. Now, here's where strategic planning shines. By repositioning your non-qualified annuity income tax-free to fund long-term care expenses under a Pension Protection Act annuity, you and your children can avoid these taxes entirely. It's the only pathway where both you and your heirs can legally avoid this tax burden. If you or your spouse do not require long-term care, the entire value of your annuity will still pass on to your children with the same LIFO taxation of your existing annuity. This is the definition of a win-win situation. Through the Pension Protection Act, the government is giving you this tax break, but it is your responsibility to position yourself to take advantage of the tax break for your family. Preserve your capital assets for your children with the free step-up in basis, while using your annuity to cover long-term care expenses tax-free. This is not just about saving taxes. It's about maximizing the value of your hard-earned assets for your loved ones. Why should you or your children pay unnecessary taxes when a little planning ahead can avoid them legally? It's not just planning for the future. It's about making the most of your legacy today. Take action now. Preserve your assets, maximize your legacy, and ensure a tax-efficient future for you and your family.
So you can see how this one-page piece can be extremely powerful for you to communicate the advantages of the Pension Protection Act to your client. Once again, my name is Tom Vassallo with MRW Financial Brokerage. I can be reached at 813-875-6331. I thank you for your time today in LTC Seed, and we'll be happy to help you build some cases around clients that have existing non-qualified annuities. Please tune in for next week's long-term care seed on who pays for long-term care in the United States. I look forward to working with you, and have a great day. Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity.